If you've been following this channel, by now you should have a basic understanding of capital markets. If you haven't been following this channel, here's a 30 seconds explanation to get you up to date. Capital markets allow you to take your savings and put them to long-term productive use by either buying ownership in companies or by lending your money to companies or governments in order to receive it back with interest. Basically, capital markets allow you to be an investor or a bank by giving your money to entities who need it to achieve something. In return, these entities will either give you ownership in them or more money back. Capital markets have two components: stock markets and bond markets. Stock markets are the ones that allow you to be an investor in companies and receive ownership in return. I covered that in the previous video. Go watch it if you're interested. Bond markets allow you to be a bank and lend money to governments or companies to receive it back with interest. This is what we'll cover in this video. Now, bonds as a concept, as well as a financial instrument, might seem very boring at first, but they are in fact one of the most powerful forces and indicators in the market. You don't even have to buy them for them to be useful to you. Simply understanding and monitoring them can give you great insights. I will explain how they fit in the big picture in a future video, but for now I want to cover the basics. One thing I can tell you for sure though, is that if you take your time to understand them now, and if you watch till the end, you'll be thanking yourself in the future when you realize what role they play in the macro landscape. Let's start by explaining what a bond is. The simplest way to understand and to remember what a bond is to think about a loan or an IOU. When you buy a bond, you essentially lend money to an entity, and they are obliged to repay it at a later date. The money that you lent is called the principal. You also get interest on that money, which can be annually, semi-annually or monthly, but usually it is annually. The interest that you receive is called the coupon. The date at which you receive back your principal is called the maturity date. So remember these: principal, coupon, and maturity date. Now let's look at an example, because it's easier that way. An entity, like a government or a corporation, wants to raise money, so they issue bonds. The bond has a face value or a principal of $1,000 and a coupon of $50. This means that the yield is 5%. Pretty simple, right? You just buy that bond, hold it, and every year you get 5% in interest. But now here's the important part. Most of the time, you won't be buying that bond directly from the entity that issued it, like the treasury. Most of the time you'll be buying it from someone else, through a broker. Don't ask me why you would do that, because there are countless reasons. Maybe the stock market just crashed and you're looking for safer investments immediately. Maybe it's because you want a tradable bond because of the high liquidity. Maybe you intend to hold it for a short period of time and then sell it to someone else. The reason doesn't really matter. What matters is that the person who is selling the bond to you will probably not sell it at its face value. He will sell it at a price that is determined by supply and demand. Even though the face value of the bond that you're buying is $1,000, its market price might be $1,250. Once you buy this bond, you're entitled to the coupon. But keep in mind that the coupon does not scale with the price of the bond. The coupon is still $50 because it was determined when the bond was issued, and it was determined based on a percentage of its face value. It's not the government's problem at what price people decide to trade them afterwards. They could be trading at $5,000 and the coupon would still be $50 in this case. This is why bonds are called fixed income instruments. Now, if we get back to our example, you just bought a bond with the face value of $1,000 for the price of $1,250 and a coupon of $50. If you were to do some simple math, you'd notice that the yield is now 4% instead of 5%. This is known as the current yield, and it's the yield that should matter more to you. But wait, there's more. I hope you haven't forgotten about the maturity date. What if this bond has only 1 year left until maturity? Well, you're in big trouble. You just paid $1,250 for a bond that will give you back $50 as a coupon and another $1,000 once it reaches maturity, because that was its face value when it was issued. Basically, you paid $1,250 and you got back $1,050. Now you're $200 in the negative. This is called the yield to maturity, and it's actually the yield that matters the most when it comes to bonds. It matters more than the current yield and more than the coupon. I will now give you a positive example so you can understand the yield to maturity better. You buy that $1,000 bond on the market for $1,250. It has 10 years left until the maturity date. At the end of those 10 years, you get back $1,000, which is the principal, plus $50, which is the coupon, times 10 years, which actually amounts to $500. So the total amount that you get back is $1,500. You invested $1,250 and earned a profit of $250 in 10 years. That's a profit of 20% in 10 years, or a yield to maturity of 2% per year. This is why it's crucial to understand this if you intend to buy bonds, because the yield to maturity is what makes you money. Simply changing the maturity date to 5 years instead of 10, in the above example, would have reduced the yield to maturity to 0%. Now that you understand how bonds work, let's see what type of bonds exist. First, we have government bonds. These are bonds issued by a national government. They are generally considered safe because governments usually don't go bankrupt and default on their loans. The different types of government bonds are treasury bills, treasury notes, treasury bonds, and TIPS, or Treasury Inflation Protected Securities. Treasury bills are government bonds with a maturity date of 1 year or less. Treasury notes are government bonds with a maturity date between 1 to 10 years. Treasury bonds are government bonds with a maturity date between 10 to 30 years. TIPS are government bonds that make adjustments for inflation. They have a fixed interest rate as a percentage that is paid semi-annually. The bond's face value is also adjusted semi-annually to protect the interest from inflation. For example, if you bought a $1,000 TIPS with a 4% interest, but the inflation was 10%, when the adjustment comes, the TIPS value will become $1,100 to keep up with the inflation. The 4% interest will be paid for the new $1,100 value. This $100 adjustment is considered a taxable income, even though you didn't receive it in cash. For this reason, it's better to buy TIPS through a mutual fund instead of directly from the treasury. Before moving to the next type of bonds, I'll dedicate a couple of minutes to answer a question that has been asked by countless boomers on Facebook in every discussion about the national debt. That question is, to whom does the government owe the money? If I did a good job explaining bonds, by now you should know the answer to this question. The government owes the money to whoever buys the bonds. Since literally anyone can buy the bonds, the money is owed to everyone. This can include institutional investors, pension funds, foreign governments, retail investors, and even you. This chart, even though it's older, does a good job in showcasing this. Given the fact that almost everyone has a stake in the national debt, either voluntarily or involuntarily, this makes people believe that government bonds are very safe for the following reasons. The first reason is that almost the entire country would be on the streets with pitchforks and torches if the government stopped paying. It would mean that the government stole from the people. It would also be a PR disaster and nobody would trust the government ever again to lend it money. It could also lead to the government getting overthrown and replaced with a new one. The second reason why it won't default on its debt is because the government has access to an infinite money printer through the Federal Reserve, and it can always go into more debt to pay back the old debt. Sure, this will create inflation down the line, and it's just kicking the can down the road, but that's a problem for future people to figure out. The point is that if the government has to choose between stealing by defaulting or stealing through inflation, it will always choose to steal through inflation, because inflation is something that you feel on longer time frames and you won't be as upset about it as you would if it simply stopped paying or if it decided to pay you less. I believe it was in the late 70s in the United States when bonds were also called certificates of confiscation, because even though people got more money back from them, the inflation was so high that the purchasing power of the money was lower. You technically received more money in nominal terms, but you could purchase less products and services with it. Surprisingly, even though people were upset about this, they were not as upset as you might imagine, thus proving once again that people can actually be tricked by simply flashing bigger numbers in front of them, even though those numbers don't actually mean jack shit in the real world. Now that we're done with government bonds, let's move on to the second type, corporate bonds. These are bonds issued by corporations. The main difference between buying a stock in a company and buying a bond is that a stock gives you ownership in the company. A bond gives you a creditor stake in the company. What this means is that if the company goes bankrupt, as a creditor, you have priority over a stockholder. You will be repaid first. Another difference is that stocks remain outstanding indefinitely, while bonds have a maturity date. There's an exception to this in the form of convertible bonds. These are bonds that can be converted into stock at a specified conversion rate. When it comes to corporate bonds, it's important to mention that they can be classified into investment-grade bonds and high-yield bonds. Investment-grade bonds are high quality, and usually they are pretty safe. High-yield bonds are also known as junk bonds. These are bonds that have a high risk of default, but they compensate that risk with higher yields. You can think of them as your loser friend who comes to you to borrow money and tells you he'll pay you back double. Unless your friend is good buddies with the people at Renaissance Technologies, he most likely doesn't have the magic formula for making huge amounts of money. If he did, he wouldn't come to you for a loan. My point is that he most likely won't pay you back, and you shouldn't be fooled by that high interest rate that was promised to you. The same thing applies to junk bonds as well. The third type of bonds are municipal bonds. These are bonds issued by a local government or territory, or one of their agencies. They are generally used to finance public projects, such as roads, schools, airports, and infrastructure-related repairs. Depending on the jurisdiction, these bonds may be exempt from income tax. The fourth type are mortgage-backed bonds, or mortgage-backed securities. To be able to explain these, I'll have to start from the source. If someone takes a loan from a bank to buy a house, he essentially created a mortgage. The bank can then take that mortgage and aggregate it with others like it to sell it to a government agency or investment bank that packages the loans together into a security that investors can buy. These are known as mortgage-backed securities. Investors can buy those mortgage-backed securities on the market, and every time people pay their mortgages, the investor gets paid. If people stop paying their mortgages, the owner of the bond is entitled to their property. Basically, mortgage bonds are backed by real assets, in this case real estate, and are usually considered safe. There are two types of mortgage-backed securities that are important. Residential mortgage-backed securities, which are backed by residential real estate, and commercial mortgage-backed securities, which are backed by commercial real estate. I mentioned earlier that mortgage bonds are usually pretty safe. Sometimes they are not, though. The problems arise when banks take these mortgage bonds and package them into CDOs, or collateralized debt obligations. Rating agencies give these CDOs a score depending on their risk. In the 2008 financial crisis, there were CDOs that contained high-quality bonds mixed with low-quality bonds, yet the rating agencies scored them very high. The banks unloaded these CDOs on the market, and investors bought them thinking they are safe. Once people stopped paying their mortgages, the price of CDOs crashed because everyone was trying to get rid of them. Since those bonds were backed by real assets, houses in this case, those assets had to be sold. The market was flooded with a big supply of houses, and since the supply increased, the price went down. This created a chain reaction that affected the entire housing market and eventually the entire world. The biggest culprit of the financial crisis was in fact the synthetic CDO. This financial asset is considered a derivative. I will cover derivatives in a future video. There's one more type of bond that needs to be mentioned, which technically can belong into multiple categories. It's called the zero coupon bond. A zero coupon bond is what it says on the tin. They don't have regular interest payments or coupons, but instead they are sold at a price below face value, resulting in a profit at the maturity date. The maturity date can be up to 1 year or less. You could buy a $1,000 zero coupon bond for $950, hold it for 52 weeks, and make $50 in profit. And that's it basically. I mentioned at the beginning that bonds are more important than they seem. Unfortunately, I don't have time to go into details in this video, because it's already too long. Once I begin covering more advanced topics, bonds will rear their head again, and I will show you how they fit in the big picture. Until then, try to remember how they work, especially how their yield is calculated. Thanks for watching and see you next time.